Nowadays, there is so much competition to get in our checkbooks every single month. Between subscriptions, utilities, credit card bills, student loans, rent or a mortgage, the competition is fierce. Not to mention the increasing rate of inflation that could be detrimental to our cash flow each and every single month. Today, we're gonna talk about why it's more important than ever to pay yourself first. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel and don't forget to hit that bell to be notified when we upload new videos every week. The golden rule in personal finance is to pay yourself first. But the question becomes, how do you do that? There's never been more competition. It's never been easier to give away control of your cash flow with so many subscription options as we have today.
Whether it's a large corporation, a small company, a financial institution like an investment firm, a bank, or an insurance company, or the government, they all are experts at getting into our checking account and getting into making sure that we're paying them first rather than paying ourselves first.
So the question remains, how do we pay ourselves first? And the answer is simple. It's to get $1 to do multiple duties. What if you were able to get $1 that you were, let's say, repaying a credit card with to do multiple duty so that it's also able to continuously compound interest and be working for you at the same exact time?
And that's the secret. Think of this question. What's the rate of return on getting $1 to do several jobs? Well, the answer is it's almost infinite. And that's the key. Making sure your money is much, much more efficient than just doing one job. But that takes us back to the original question. How do you pay yourself first? Well, first and foremost, you have to prioritize savings. And it's really simple, and it's also very hard. So think of this. I'll never forget when my son got his first real job after college. And after he got his pay, he was figuring he was gonna make about $2,000 for his first pay. And when he got his first pay, it was closer to $1,100. And I'll never forget what he said to me. He said, "Dad, who in the world is FICA?" And I said to him, "Welcome to the real world, son." So again, how do we pay ourselves first when we're only gonna end up with 55% of what we think we're gonna get in our first pay? Well, it's real simple. You gotta make sure that you're underestimating how much you get and also prioritize and say, okay, whatever I get, 10% is going into my savings, or some number. Could be 5%, could be 3%, but you need to start somewhere.
So when it comes to compounding interest, there are two factors, and only two: time and money. We can never get the time we lose back. So it's important to start saving now and save as a matter of course. Save month after month, week after week, and never drain that tank so that you could experience the eighth wonder of the world, compound interest.
And we talk about not draining down the tank. What does that mean? Well, typically what happens is people save, they have great intentions, and then all of a sudden a disaster hits them. They have a financial or a medical emergency, so they wipe out their savings. Or they're saving money and all of a sudden they need to buy a house or want to buy a house. So what do? They drain down their savings and use their savings for a down payment on the house. Well, what happened is you drained down the tank, you stopped compounding interest on that money. So again, the key is getting $1 to do two things. What if you could put that money in a place where you can utilize it to do whatever you need, whether it's a financial or a medical emergency, a down payment on a house, paying cash for a car, what have you, but you could still make that money continue to grow and earn uninterrupted compounding of interest.
Because what happens when you drain that tank and deplete all of your savings is you lose all the opportunity that that money could have earned you. You'll never see the interest that you don't earn on that savings.
But more importantly than the opportunity, you just lost all the time it took you to build that money up. Now, you'll never get that time back either.
So, when you look at a compound interest curve, in the beginning years, you don't see much growth. Now, as a reminder, compound interest is when you are earning interest on the interest, and that interest continues to compound and grow and grow and grow every single year. And in the beginning years, you don't see much growth. But by continually draining down that tank and knocking yourself back down to zero and starting all over again, you'll never experience the real growth on your money. And so it's so important to never get off that compound interest curve, because by the time you realize the detrimental effects this is going to have on your finances and your ability to achieve your financial goals, it's going to be too late.
And this is where we always say, the future you needs to have a sit-down discussion with the present you, because the present you on how you're using your money could really be shortchanging the future you out of a comfortable retirement.
So here's the key. Pay yourself first and never stop. Pay yourself as a matter of course and never drain that tank. One of the ways we help our clients achieve this goal of paying themselves first is with a specially designed whole life insurance policy designed for cash accumulation. So they're able to meet their short-term goals of, let's say, paying off their credit card debt or paying off their student loans, as well as their long-term goals like paying for a wedding, sending their kids to college, or saving for their retirement income. If you'd like to get started with a specially designed whole life insurance policy designed for cash accumulation to meet your short-term and long-term financial goals so that you could save as a matter of course and pay yourself first and never drain that tank, be sure to visit our website at tier1capital.com. Feel free to schedule your free strategy session today or check out exactly how we put this process to work for our clients in our free webinar, The 4 Steps to Financial Freedom. Leave us a comment down below. Let us know about a time that you had to drain the tank for an emergency and what effects it had on your finances. Also, if you like this video, please be sure to give us a thumbs up and don't forget to subscribe.
Thanks so much for watching this video. And remember, it's not how much money you make.
It's how much money you keep that really matters.